You guys, I want to start this off by apologizing. My last video about property taxes in South Carolina seemed to stir up a little bit of confusion, and I get it. Taxes are not exactly the most exciting thing in the world. But listen, if you own property or plan to buy here, this is something you need to understand, because the difference between a 4% and 6% tax rate is not just a couple of percentage points. It can mean thousands of dollars every year. So grab a coffee or whatever your beverage of choice is and get comfortable, and let's break it down together. I'm going to walk you through exactly how property taxes are calculated, what the assessment rate is based on, and why two identical houses can have very different tax bills. It might get a little dry at times, but stick with me because we're going to make sure that you walk away knowing exactly how this works so you don't get hit with an unexpected bill later on. By the end, you're going to know exactly how South Carolina's property taxes work, what you need to do to get the lowest rate possible, and how our tax rates compare to some other states. My name is Deneene Gary, the Southern Living Yankee, and a realtor in Charleston, South Carolina, and the surrounding areas. I specialize in helping people relocate to Charleston from out of state because I've been there and I've done it myself. I know how exciting but still overwhelming a big move can be. But that's why I'm here to make it easier. Whether you're buying, selling, or just exploring your options, I'll provide honest advice and expert guidance every step of the way. If you're ready to start your journey, reach out today to find out how I can help you save $1,000 on your moving costs. And don't forget to like this video, subscribe to the channel, and hit the notification bell so you'll never miss tips on living your best life in Charleston and the rest of the Lowcountry. In South Carolina, property taxes are calculated using an assessment ratio applied to the property's fair market value, not a direct percentage of the full value of the home. Here's how it works. We have two different assessment rates. First, let's talk about what the 4% and 6% assessment rates actually mean. Primary residences, which are owner-occupied homes, qualify for the 4% ratio. This means you're only taxed on 4% of your home's market value. Second homes, rental properties, commercial properties, and land that doesn't qualify for special agricultural use fall under the 6% ratio, meaning 6% of your home or property's market value is taxed. To qualify for the 4% rate, the home must be your primary residence. This means it's where you legally reside, register to vote, file your taxes, and have your driver's license addressed. There is no strict rule on how many days per year you have to live there, but you can't claim residency in another state for tax purposes, and you can't rent the home for more than 72 days per year. Otherwise, it gets bumped up to the 6% rate. Now let's talk about how property taxes are actually calculated. Your home's assessment ratio determines its taxable value, which is then multiplied by your local millage rate, which is your county's tax rate. I want to break this down for you. Let's say you own a $300,000 home. At 4% assessment, $300,000 times 0.04 equals a $12,000 taxable rate. At 6%, it's $300,000 times 0.06, which is an $18,000 taxable rate. Next, we'll apply a millage rate. Let's use 200 mils, which equals 0.200 in the decimal form. A 4% assessment is $12,000 times 0.2 or $2,400 in annual property taxes. For the 6% assessment, it's $18,000 times 0.2 or $3,600 in annual property taxes. If you qualify for the 4% assessment, you don't have to pay school operating taxes, which make up about half of your tax bill. That's why the difference between that 4% and 6% rate is so dramatic. But here's something to keep in mind. You have to apply for the 4% rate. It's not automatic. If you move into your home, you'll need to file for the owner-occupied exemption with your county assessor's office. There are some exemptions and deductions that may be available as well. Primary residences at 4% qualify for exemptions, including the school operating tax exemption, which significantly lowers the tax bill. Rental properties, second homes, and commercial properties at 6% don't qualify for those exemptions. Now, let's see how South Carolina stacks up against some other states when it comes to property taxes on a $300,000 home. Let's take a look at this chart that, as I am saying this, I am hoping I can get it to pop up on the screen for you. I'm a visual learner, so I thought I would put this in for anyone else that is the same way. Just a little disclaimer, these numbers are estimates and may vary based on local millage rates and exemptions. Here we go. So the state effective property tax rate for annual taxes on a $300,000 home in South Carolina at 4% is 0.51%, or about $1,537. South Carolina at 6% is 1.02%, or $3,074. So we have New York, we have North Carolina. I also included Ohio because it's the #1 state that moves to South Carolina, Pennsylvania because that is where I came from, California because I've been getting a lot of calls from Californians wanting to move here, Washington State, and then also Florida because I have some people that are wanting to move back from Florida to South Carolina. If you qualify for the 4% assessment rate, you could save thousands of dollars per year compared to other states. So let's look at a couple examples. Compared to New York, you'd save about $3,623 per year. Compared to Ohio, $3,143 per year. Pennsylvania, you'd save about $2,933 per year. Florida, you'd save about $1,193 per year. Even at the 6% rate, South Carolina's property taxes are still lower than many other states, but that 4% rate is the game changer if you're living full-time in your home. The bottom line is this: if you're moving to South Carolina, make sure you apply for the 4% assessment rate if you're living in your home full-time. It is not automatic. You have to file the paperwork with your county assessor's office, and if you're thinking about renting your home out, you need to be careful. If you rent it for more than 72 days per year, you will be bumped up to the 6% rate, which will double your tax bill. I hope this clears up the confusion from my last video. If you still have questions, drop them in the comments. And if you're thinking about buying or selling a home in South Carolina, reach out because I would love to help. My name is Deneene Gary, the Southern Living Yankee, and a realtor in Charleston, South Carolina and the surrounding areas. I specialize in helping people relocate to Charleston from out of state because I've been there and I've done it myself. If you're ready to start your journey, reach out today to find out how I can help you save $1,000 on your moving costs. Don't forget to like this video, subscribe to the channel, and hit the notification bell so you will never miss tips on living your best life in Charleston and the rest of the Lowcountry. Thank you so much for joining me. So long for today.